I'm going to be straight up and real for a minute, which I always am, but this is going to be a pretty hard reality. So look, if you're doing $100,000, $200,000, $300,000 a month in your D2C brand, you could still be going broke and headed for that brick wall of bankruptcy that I kind of talk about. I know this isn't what you want to hear, but it's the hard truth of the reality. And so I've been working with D2C in the D2C space for over decades, and I've seen these points come up that causes e-commerce companies to collapse, like literally can be 1 month from non-existent. So here's the thing is, what I find is most founders have extremely great gut instincts, and that's gotten you to where you're at. However, without the proper financial data and a way to look at that and understand that, then it can lead to bad decisions, bad strategies that you're putting in place and deploying. And so I'm going to go through a quick list of things that you can literally implement today to understand if you're on the right track or not. So point number 1 is reviewing your financials in a regular cadence. Look, I'm going to be completely honest here. As a CFO, for D2C brands, I hate accounting. So I get it. I understand accounting. It's just not my forte. It's too black and white for the way that my brain works. Now, knowing that, we still have to dig into the data. I get it. You don't want to look at this long chart of accounts on your profit and loss statement and your balance sheet. And how does the balance sheet correlate with the profit and loss? And what does this actually mean in my business? How does this affect my marketing spend and my customer acquisition cost and my customer lifetime value, all of that. However, your financials, especially your profit and loss, is the report card on how you're operating your business. Are you good? Are you bad? Are you failing? Right? And so you want to make sure that you're in a regular cadence and review it in a way that your brain can digest it, whether that's through graphs, charts, maybe it's long P&L, maybe it's truncated, so you just want the high level, but you need to be reviewing it at a minimum on a monthly cadence to understand how your month performed, how you're doing year to date, how you're doing year over year. And so this will quickly give you a sense of, are we doing okay? Are we just barely hanging on? But get into the routine of reviewing it on a regular cadence. Point number 2, and I have seen this, I don't know how many times, but founders will just hire, or have their CPA like doing their bookkeeping, and the accounting method is not correct. Like I said, I'm not going to get on the details of accounting methods, but there's cash and accrual. And so I've seen brands doing as much as 8 to 10 million on cash basis accounting. In fact, I had to talk with another CFO that was on a call with a client doing 50 million on cash accounting, which actually at that point you're forced to go to accrual, but way before that. So what happens when you're on the wrong accounting method is when you're on cash basis, whenever you order inventory, say you order 100,000 of inventory, that gets written off as soon as you pay for it. When that wire, that ACH, when that payment leaves your account, it gets categorized, right? However, you might have had 150,000, 200,000 in sales that month. So your cost of goods is going to show like 50%. If you're doing 100,000, you did 200,000 that month. But that inventory is not aligned with those sales. And so why do we want to get to accrual? Because, and I'll get to this point next, but you're not going to understand your margins on cash basis, right? So 1 month you're going to be highly profitable because you didn't order any inventory. The next month you order inventory and you're like, you have a huge loss for that month. And so for you, it's going to be like this going up and down, and you're not going to be able to deploy any type of strategy or understand if you're profitable or understand your margins. So number 2, make sure you're on the right accounting method. Now, how can you look at this? Just quickly, whoever's doing your financials, bring it up, have them bring up the P&L, look at the last 6 months, month over month. And if your cost of goods is fluctuating on a monthly basis, if you have some months where there's no cost of goods and some months so there's hundreds of thousands of dollars, then you're on cash basis accounting and you need to get switched to accrual so that your financials can serve you to make better decisions in your company. Point number 3 is not knowing your customer acquisition cost. And so this can be huge because you need to understand, if I'm paying $50 to acquire a customer, what's my average order value compared to that? What's my contribution profit to that, right? So what do I mean by that is your average order value might be $80, but by the time you remove your cost of goods, your shipping, and your merchant fees, you might actually be losing money on that acquisition, right? So your contribution profit might go down to say $45 and you paid $50 for the customers that you acquired that month. Now, if you don't have strong customer lifetime value, that might be a bad thing. You might not break even on those customers, say for 8, 10, 12 months. Now, if your customer lifetime value is really strong, then you might need to get more aggressive. You might be losing out on future revenue because you're not you're not spending enough to acquire customers, knowing that you're going to break even the second month, and then it's going to continue to escalate through the year. But from the start, where I always peg people is like, set your customer acquisition cost where you're going to break even on that acquisition if you don't already have this fully baked in where you can understand your data. And then from there, you can start to get more aggressive and pull back, or you can push forward and, have maybe bigger losses that first month, depending on your customer lifetime value. But from the start, you need to understand, what am I going to tell the ad agency? What am I going to tell my performance marketer? How much they should spend to acquire a customer? And so you need to know those numbers. Point number 4 is ignoring your email list. And I don't mean like completely ignoring, but just not making it as efficient, not dialing in your flows, not understanding how much your campaigns are fluctuating, right? And so you need to have historical data, how much, and when we're talking attribution, every software tries to take full attribution, right? But you want to understand the trends of your email list. How much value is in your email list, and are you maximizing that, right? Do you have nurture sequences going? But you want to understand how much percentage of your revenue is your email list driving per month. And for D2C brands, we want that at a minimum of about 30%, right? And like, that's minimum. And I mean, we have some clients that it's 50 to 55% of their monthly revenue is coming from their email list. And so when you look at that, like if you're operating at 30, but you could be operating at 55, how much more revenue that could be bringing in? And these are customers that you've already spent to acquire. So you need to maximize the efficiency of them to create long-term clients through time. Point number 5 is your cash flow management is non-existent, right? You're just kind of looking at your bank account. Okay, we've got the balance that we can cover, the next payroll, or we can cover our next inventory order. But you need to have like a better grip on your cash flow and what's coming up over the next 2 to 3 months. Look at your sales demand plan. Are you going to be covered? Have you created enough spread where you're taking and you have a cash reserve to the side? Because I mean, let's face it, like what we just went through, which is things change, right? Meta algorithms change, tariffs change overnight, right? So all these things happen. The D2C world is consistently changing. Like, that's what we know. And you're having to pivot all the time. And so you want to have a few things in place. You want to have cash reserve set to the side. And I'm sure you get the Shopify Capital or all of these, quick debt structures that are presented to you. And when you need liquidity, it's like, it's so easy, boom, money's in your account the next day. But the one thing that I always tell people is, if business is good right now, go to your bank and establish a true line of credit, because then it's just always going to sit there. If you need to tap it, you can tap it, pay it back, but you're only paying percentage on what you're drawing there, right? And so the difference between that then is you have control on how you're paying that back. If you're just going to pay interest on that for a few months, if that's what you need, you just need to buy some time. But when you take out like the Shopify Capital loan, they're literally taking 17% of your deposits every single day, and you lose that flexibility, and it's a lot more expensive. So those are two things, but understanding your cash flow management, setting, cash reserves aside, and just for the event, is establish a line of credit for your business. Point number 6, you're not managing your margins. So we go back to point number 2 about the accounting method. If the accounting method is wrong, you're not going to understand your margins. But when you're on an accrual basis, you can quickly look at your gross profit, what's your shipping expense, what's your merchant fees, and that can show you what you can spend to acquire customers, what your overhead needs to be, right? So typically with D2C brands, we want the gross profit margin to be 80% or higher, meaning your cost of goods is about 20%. Now, some it goes up to 10, some it goes down to 30, so you only have 70% gross profit, but that's kind of where we like to peg it. And so from there, then we know shipping fees with pick pack should be around 10 to 12%. Your merchant fees are about 3%. And so when you understand those margins, you're like, okay, my overhead, say, is 15, 20%. You can back into what percentage of revenue should I be spending on advertising and marketing? Does that coincide with the CAC target and the first time customers I need to acquire? And then what's left is your profitability. So at least you have these big buckets where you can put some guardrails around and understand if you're hitting those or if you're not. But again, it goes back to that foundation piece. If you don't have the right accounting method, you're not going to understand your margins at all. But if you do have that in place, then you can put these targets when when one's out of whack, you can go back in and really focus on that. Like, how can we get our cost of goods lower? Do we go back to the manufacturer and do we negotiate with them, right? If we order more quantity, can we get that lower? And so you can start asking these questions and really dialing in and getting efficient with your business. So look, I know I've been kind of direct. It's not all doom and gloom, but hopefully you found this valuable. I mean, I've just seen this across the board where these are the things that D2C founders start, and then they get to a point where they're doing 1, 2, 3, 4, 5 million a year, and they could be growing at a much rapid pace. Or they, even at those levels, they could still be headed for that bankruptcy brick wall that I talked about, right? Where they're just 1 month away or one ad account being shut down from being non-existent. And then that's when you start getting into trouble and taking on debt that's not the most advantageous for you, right? So if any of this resonates with you, if you don't feel like you've got a strong hold on your financial foundation, or don't understand your customer acquisition cost or how that relates to your customer lifetime value, like, we should talk. There'll be a link below. Feel free to leave a comment, book a call with me. More than happy to walk through it with you to give you some insight. And we'll see you next time.